Hi, my name is Courtney James with Acuity Advisory Corp, and I'm here today with John Burke, newsletter writer and investment advisor representative at TWPM. He has focused in the mining industry for the majority of his career and has some amazing insights into it. So, John, thank you so much for joining us today.
You're very welcome, Courtney. Nice to be here.
Amazing. So I'm just going to start by getting you to give us a brief overview of your background and experience, especially in the context of public markets.
Yes, I have been in the investment business for over half a century. And just doing the math on that takes me back into the 1970s and I will be making some comments about the 1970s. And most of my career was spent with various New York Stock Exchange firms. I struck out on my own and set up an investment advisory firm in 2004. And recently I joined TWPM through the Raymond James system as an advisor representative for TWPM.
Very nice. Okay, amazing. And which sectors are currently capturing your interest at the moment?
Commodities, commodities, commodities.
I like it. There we go. You know what you're looking at.
Yeah. There's no, there's a couple of little glitches away from that, but most of them are somewhat are related to the commodity area.
Amazing. Well, I don't know if any of our viewers read John's newsletter. It's very comprehensive, very insightful. So the recent one that you put in at the end of last week focused on uranium specifically as we're discussing the commodities market. And here I'll bring the charts up on the screen to give you all a preview of it. And I'll also attach the link to the newsletter below if anyone else wants to check it out. But I just kind of wanted to start by discussing how the point and figure charts and the bullish scenario for uranium translate for average investors, especially when comparing uranium to the S&P index using the Vanguard ETF symbol VOO.
Okay. Yes. I like, for starters, to compare a chart with something else on a ratio basis. Rather than just looking at the price of a stock or an index or an ETF by itself, it is much more meaningful to compare it to especially the S&P, because S&P represents the broad market. So by comparing it, you can see how it is doing against that broad market. And that's extremely important, because if the funds are coming out of the broad market, i.e. stocks, then they're likely moving someplace else, commodities.
Right. Okay.
And we've had several cycles that I could go into if you'd like. In my investing experience, and this is not something I read about, I've actually lived through different commodity cycles that we've had over the last 50 years.
And what are some trends in those cycles that you've noticed?
Well, the first cycle was the 70s. And there's an enormous amount of similarity between the 70s and today, especially with what is brewing with the Israeli war in the Middle East. We had a similar conflict back in the early 70s, which a lot of people think was the spark to the Iranian problem, and also a cause of the much higher oil prices. And those of us who were driving back then had to stand in line every other day to get our cars filled. So we had a serious oil crisis. And because uranium is an energy source, it has a tendency to move to the upside when oil prices are doing the same.
Right.
So not only did that take place in the 70s, we had a similar situation take place from 2000 to 2010, brought on by the Iraqi war. Many of us may think back to those days when we were paying $1 a gallon in 2000 for gasoline. versus today's prices.
Mhm.
And that was largely brought on by that war effort. And that also brought on a 10-year commodity cycle versus a declining cycle for the S&P.
Well, and my next question here kind of filters into that. We're talking about geopolitical factors, but how does the current geopolitical situation, such as those with Russia and China, resonate with this observation in the context of the uranium market? That history, the context being that history never repeats itself, but often rhymes.
You're taking a line from my last week.
I am, yes.
Or from who's the author that came up with that? Well, anyhow, I can't think of it offhand. The 2000 time period. Could you repeat that question? I'm sorry.
Yes, no, that's all right.
Okay.
So in your piece, and I can, I'll take a look here and
Okay,
find
you went into the political situation. I'm sorry. Okay.
No, that's
yeah. The politics of the Mideast oil are crucial, and China and Russia are romancing Saudi Arabia. That is extremely important in the energy picture, to the extent that we are not able to continue as we have been since the early 70s with our relationship with Saudi Arabia, whereby we use petrodollars, the US dollar, to buy, or OPEC uses the dollar to buy, for everybody that transacts in oil around the world has to use the US dollar via the agreement with Saudi Arabia. Now, China is trying to change that along with Russia. To the extent they're successful, the Chinese political situation can, and especially if Saudi Arabia favors them and Russia over the United States or the Western countries, it would have a severe impact. The other impact, of course, is going to be this current Israeli war. We don't know what the outcome of that's going to be as far as oil prices are concerned. And I don't believe that we're able to continue to depend on shale oil in this country. So again, the Chinese situation politically is very important to how the things play out in the oil patch.
Okay. And so then, given the increasing demand from the global warming community and investment buying from funds like Sprout Physical Uranium Trust, where do you foresee the demand supply balance of uranium heading in the next few years here?
Well, in the very chart that you referred to, actually, no, I'm sorry, it wasn't in that, but in my comments, I pointed out the tremendous increase in the 70s period. I believe we were up, uranium was up 4 times during that time period. In the aughts, it was up from $8 to 120, 130, I believe. And that was some 16 times. So given the oil issues and potential serious nature of those issues, the demand for uranium can increase dramatically based on that situation alone, because we can't forget an energy, and an energy which has an interesting twist to it on this cycle, because the Greens, or those who are very concerned about low carbon emissions, have all of a sudden found themselves embracing uranium because it has no carbon emissions. And if that continues, and it is in fact continuing in China and India and Japan, reopening some of their old nuclear facilities, their nuclear facilities. If that continues, it's just going to create that much more demand. And in a situation where the Russian supply, which has been supplying the market for the last 10 to 15 years, and utilities have been really in a favorable position in the United States because of that, that is going away.
Mhm.
because Gazprom, which is the largest producer and has been supplying them, it will no longer be in the picture, in my view. I think what they do produce is going to go to either Russia or China, and it
Right.
will not be coming to us. So the Eastern or the Western miners have to make up that supply. And their situation has been they have not been producing because their cost of uranium, or production rather, their cost of production is north of $70 a pound.
Right.
And so they can't produce profitably. So we need much higher prices for that to take place. So you have this tremendous demand situation with a dwindling supply, which is a tremendously explosive economic environment for any utility or excuse me, any commodity. But the one as small a market as uranium is, it can become much more explosive. And in both of those cycles that I've talked about, 70 and 2000, uranium was without doubt the leading commodity. So take that for what it's worth.
I know China has been very proactive in building nuclear reactors lately, really spurring that with plans to build many more in the coming years. Whereas you still see a little bit of lag and some reservations with Canada and the US reactivating their nuclear reactors and kind of getting on board that trend, though it does seem to be happening. Is, hypothetically, say we have enough uranium supply, do we have enough nuclear reactors to effectively power both Canada and the US?
At this point, no, because
Okay.
of what it could mean from the standpoint of carbon emissions. We could use a lot more, and the fact that they have been so slow, the Western world in particular has been so slow in building them. Germany, of course, has done away completely with
Yeah.
all of their reactors. So yes, we need more, but I think one of the interesting answers on the horizon, and it's on fairly long-term horizon, not until 2028 to 2030, are what they call small modular reactors.
Okay.
And are you familiar with what they are? Well, they're essentially units that can be moved from a mobile standpoint that create nuclear energy.
Wow.
And the thought process with the utilization of them, in particular in this country and possibly as well in Canada, is that they can be put into the same areas with the in-place infrastructure that coal-fired plants, most of which have closed, have in place. So if they can start using these nuclear reactors, small modular reactors, in those situations, it would be extremely favorable and a new source that doesn't exist now
Yeah.
of your demand for uranium.
Wow. I'm gonna have to look into that a little bit more. That sounds fascinating.
Yeah, that's there's not too much that's been publicized about that because it is fairly far off in the future.
Right.
But there are a couple of really interesting companies in that area that it's only really one, as far as I know, that it's public. And Bill Gates is involved in another one that is, I think, coming public in the next couple of years. So,
Well, kind of speaking of these advancements in this area and your fascination and interest with the commodities market, specifically uranium at the moment, um, what like what should investors be particularly attentive to, and how should they navigate this market and the associated risk with it to make lasting, safe, not all investment decisions can be safe, but knowledgeable decisions?
okay, one thing that I will caution everybody about is uranium is very volatile.
Right.
It doesn't go up from here 16 times in a month or 2 months or whatever. And it doesn't go in a straight line from one
Right.
to the other. The chart that I just put out last week is a good example of what I'm referring to there. It went up to the uranium itself, and I used the Sprott Uranium Physical Trust as the example in the chart that I presented, it ran up to the low 70s and pulled back about 10, 15, 20%. So if you were a buyer chasing it when it was in the low 70s, all of a sudden you found yourself behind the 8 ball, 10 or 15%, as it consolidated. Now, the interesting thing about the chart that I presented in the weekly is it has done that, completed that consolidation in a fairly short period of time, and now appears to be headed to the next level,
Right.
wherever that may be. And I have no clue. My crystal ball is cracked when it comes to that.
Foggy at the moment. Well, yeah. Okay. Are there any particular companies that you've been having your eye on?
Well, I have, one of my favorites is a U.S. And soon to be producer and miner, Uranium Energy Corporation. I have high regard for Amir Amani, who is the CEO of the company. He's done a wonderful job, not only with his company, but with the uranium industry in general, in getting a lot of the people in Washington to start focusing on uranium. And UEC is the symbol. It is currently approaching $6 a share.
Wow.
And I've been with that for a long time. I have some very nice gains out of that, to the point where a number of accounts, I do not allow any one particular stock to get above 10% of one's holdings. So I've been trimming a number of them back where that has become 10% of their portfolio.
Wow.
So it has been a very rewarding stock. Another couple that I like, well, I like NextGen, which has some of the Canadian Explorer, who has some really attractive assets. But I've been buying NextGen through a company called Mega Uranium that owns multiple millions of shares of NextGen at a 40% discount to what the NextGen is currently selling at. Don't hold me to that exact 40%, but it's in the range of a 40% discount to what the NextGen is selling for. So NextGen's on sale for 40% at Mega. So,
okay, that's a good deal.
That's not one of Donald Trump's.
Amazing. I'm gonna look into both of those, and I'll attach the links in this video
Yeah.
too, if anyone else is interested. John, I really appreciate all of your insights on the uranium market and the commodities market in general. And I think that you speak with a lot of experience, and it's interesting to hear your reflection of what's paralleling currently as to what had happened in the 70s and the 2000s. So I really appreciate that comparison. Is there anything else that you want to share before we wrap up here?
Well, the other thing, and we could have another long conversation about this, are the precious metals. They have not been so precious lately.
They have not been.
They have not been. But therein lies a very, very good opportunity, because I will also remind your listeners that the precious metals also did extremely well. And you asked me a couple of questions online that I think are pretty relative to your listeners. There could be relative to your listeners as a way to participate heavily in that sector by diversifying.
Right.
And diversification is important. And the sector is such that it has a great deal of diversification. We don't have time to go into that now, but maybe it could be part of another conversation. Let's do that. Let's chat about precious metals and the diversification next time. Okay, we certainly covered the waterfront on uranium, I think. I can't think of anything else. I mean, it's so interesting. It's easy to talk about uranium. I mean, precious metals are also interesting. They're just a little bit chilly at the moment. Yeah, they are chilly, but one of the keys is the chart that I sent to you about the S&P versus the producer price index. Right. When the S&P is declining below the producer price index, And that has happened 5 times actually since the 1920s.
Wow.
We've alluded to 2 of them, the 1970s and 2000. But when that happens, and the one other chart that I sent to you is gold versus the S&P.
Mm-hmm.
So when gold starts to trade better to the S&P on a ratio basis,
Mm-hmm.
keep in mind that gold is about 2,000 and S&P is around 4,000. So it's like close to 50 to 1 ratio.
Right.
When that ratio starts to exceed well beyond 50, it's an indication that money is flowing into gold and seriously out of stocks.
Yeah.
And that cycle is likely, when it does take off, to last a fairly long period of time, as they have in the past.
Right.
So
interesting. I like it.
Okay.
Good stuff. Well, thank you so much, John. We'll talk more about precious metals next time we have you on here.
Okay, good, Courtney. Good. Nice chatting with you. Right.
Nice chatting with you too. Bye.